I have a presentation that I'll go through here, but I'm not going to go through all of this. I will spare you the Cortland story and really focus my comments on what is happening in the United States with regard to multifamily or apartment fundamentals. There is a recovery coming out of the economic downturn of 2008-2009 in both the space market, the supply and demand of space we're in today. We're using this space and there's space, so there's demand and supply of space, as well as the capital markets. And both of those had a significant impact on valuations of real estate in the United States, and probably here as well. And I'm more than happy to be interrupted at any time for questions, or we can talk about questions at the end. But I'm going to really focus my comments on a macro basis with regard to the entire United States as opposed to an individual market. Although I'm prepared to talk about individual markets that Cortland has chosen to invest in, if you would like. So let me flip here and start with demand. In the United States, there is a certain population demographic that chooses to live primarily in apartments. And those are people between the ages of 22 years old and 34 years old. 65% of this population group rents, and they rent apartments. And then they're still here. You know, we turn 35, we start to get married, we have children, we buy homes in the U.S. But the primary renting years are between 22 and 34 years old. And 2/3, 65% of the population rents. This graph here tracks demand, the number of people in this age group over time. And there's a significant change over time that's important. If you go back to the late 70s, through the 80s and into the early 90s, there's a big bulge here. And this was the population of the baby boomers, those born after World War II, who started to enter this age group. I'm one of those. And so it's important to note that there were 78 million of me out there, baby boomers in the United States. And during the 80s and early 90s, we rented apartments primarily. So you can imagine there was a meaningful increase in demand for apartments, rental apartments here. And then it started to wane as this group of people got older and they chose a different style of living. They started to buy homes. Well, we were followed by the next generation, Generation X. The baby boomers are 78 million strong. Generation X, 42 million. So you can imagine that during the 80s and early 90s, 78 million units of demand coming through the system, followed by 42 million units of demand. A significant drop in the demand of apartments during the 90s, the late 90s, and into the first part of this century, last 10 years. Well, Generation X continued to age, and they're now moving on to their next phase in their life cycle, and they're replaced by what's called the Echo Boomers, or Generation Y, the Millennial Generation, a number of names. The important thing to note here is that you see a significant increase, 81 million strong. So over the last 15 years, we've had demand moving through the system of 42 million people. Now we have demand moving through the system of 81 million people. So almost a doubling in demand in this primary renting age group. So you can imagine that occupancies will increase, rents will increase from a demand perspective, but then we have to look at supply. And whenever you have, well, let me go back here one quick second. There's a lot of clarity to these numbers because we know how many people are going to be 24 years old next year. They've already been born. We can count them. So there's not much uncertainty about the size of this group because they've already been born. So there's a lot of clarity with this, which gives us a lot of confidence on the demand side of the equation. And again, it's a macro level for the United States. Where are these people going to go? We have a very mobile society in the United States. They will go to where the jobs are, because that's how they will afford to live, where they can get a job. And so you have different markets throughout the United States that have faster rates of job growth than other markets. And so these people are going to congregate, if you will, in the markets where they can get a job. And that's generally, and it's a general statement, generally in the southern tier of the United States, what some people refer to as the Sun Belt. Not many of these people are moving to Detroit, Michigan, for example. But let's talk a little bit about supply. And this is tracking that same time period, 1979 through today, for supply. This chart shows the new construction starts. This is hundreds of thousands of apartments. So in this period, mid-80s, there were 600,000 apartments started construction during that time period. And it takes about 2 years to build them. So if you're really looking at the delivery of new supply, which is what we're really trying to match up with demand, you would kind of shift this 2 years forward. But this is just the start date. And you saw there was a huge increase in supply back here. Why? Because there was a huge increase in demand. Well, as we do in the United States about every 17 years, we overbuild things. And so there was a financial collapse in the late 80s and early 90s, and you see there was a savings and loan crisis. There were over 3,000 banks that failed during this time period, primarily due to their real estate lending, because there was too much supply relative to demand, not just in apartments. It was in all office buildings and retail centers and the like. But when the savings and loan crisis hit, the regulators shut down the banks. And so they couldn't make any new loans. They couldn't make any new loans. There were no new construction starts, because you had to have a loan to get a new deal started. So there was a significant drop off here. Well, as we move forward, and that's history, as we move forward through the 90s and the 2000s, we ran into the capital shortage that occurred in 2008 and 9 and 10, where in a similar vein, but for different reasons, in a similar vein, the regulators shut down a lot of banks in the United States. And because they shut down a lot of banks, even those banks who were not shut down were very reticent to make new construction loans. And so there was a significant drop-off in the construction financing for new apartment properties, not related to a drop-off in demand. If I go back to this slide, you see significant increase in demand. But when I go forward here to supply, supply dropped off. And supply dropped off because it was a financial issue, not because there was a lack of demand for the product. And so when we combine these two, we get a sense of what's going on in the space market, demand for space relative to supply. And you see that we have a significant shift in the balance between demand and supply that's heavily biased toward demand. As a matter of fact, it is physically impossible to deliver enough new supply in the United States for apartments over the next 3 to 4 years to meet the demand. The demand is shooting up. The supply is at very low levels. And remember, this is financing. It takes a couple of years to build it. And because the banks made no loans in 2009 and 2010, very few in 11 and very few in 12, there's just not enough supply being built to meet the demand coming for the next 3 to 4 years. So as a result, we have this outsized opportunity, if you own apartments, to generate high growth in rents and revenue, net operating income, cash-on-cash yields. As a matter of fact, here, this is projected vacancy rates for apartments. At the end of 2014, and this comes from an economist, a gentleman named Peter Linneman, who heads up the real estate department at Wharton, which is part of the University of Pennsylvania. He projects by the end of 2014 that vacancy will be 1.9%, meaning we'll be 98.1% occupied. That's because of this huge imbalance between demand, and you just can't deliver enough supply fast enough. Well, the highest we've ever been occupied before in the United States is 95.6%. And that was back here when I was in my primary renting years. This is an unprecedented level of occupancy in the United States. It suggests that we'll have rent growth significantly ahead of inflation because there's just not enough supply to meet the demand. So that's, yes.
It's not very clear what is really the demand. Is it the actual demand or the potential because of the renting age population?
Very good question. What we know for sure, based on history, is that 65% of this age group, 22 to 34-year-olds, 65% of that group rents. If you go back over a long series of data over time, 2/3 of that group rents. And if you apply that same math to what you know for sure, which is how many people are going to be a certain age over the next several years, and you apply that math, you project what demand will be. There are other factors. It could be lower. It could also be higher. It is likely to actually be higher. And the reason it's likely to be higher is the single-family home market, people buying single-family, collapsed in the United States. And so there was a portion of people who were 27 or 28 or 30 historically that would go out and buy a home. Maybe they got married, started to have a family, they would go out and buy a home. And even though they were in this primary renting group, age group, they were still buying a home. Today, because the financial system has cut back on the availability of single-family mortgages, it's extremely difficult to get a loan today in the United States to buy a home. And these people who may be thinking about buying a home over the last 5 years have seen nothing but home price depreciation. And so they're not interested necessarily in buying a home where the values aren't going to go up. If we go back during this time period, see this big bulge of people who were renting? Well, they were still here. They just, during these years, they were still here. They just moved into their home buying years. So what do you think happened to the demand for homes in the 90s and in the first part of the 2000s? Well, you had 78 million people kind of reaching their home buying years. And in the United States, actually about 65% of the people, interestingly enough, coincidental, own homes. If you look at the total population, 65% of the population owns homes. When you're 22 to 34-year-old, 65% of the population rents. But when you look at the total population, 65% own homes, which means above 34, most of the people are owning homes. So there was a group here that would maybe buy today. They're likely not to buy today or put off their buy decision a little longer, which means that, and it was probably, and it is built into this projected occupancy rate. So we are projecting demand based on historical ratios and also on the dynamic where buying a home today is very difficult because you have to have more of a down payment. You know, and part of what led to the collapse in the States was no down payments for homes in the kind of 2000 to 2005 time period. Today you have to have 20% down payment. So that's a significant change in that dynamic. And it causes someone who's 28 or 30 or 32 to have more dollars to invest in the home. And historically they haven't had those dollars. And so they're likely to stay renters a little bit longer. That's marginal. That's a marginal increase for us in the industry. But what we're primarily projecting is the historical ratio of 65% of that age group rents. And we know how big that age group is going to be. Yes?
I have a question about the supply. The supply chart shows new apartments, and
yes,
it doesn't say anything about the existing apartments
Yes.
already in the market. So I know that the vacancy rates answers part of this, but how many new apartments do I need to build annually
Excellent. Excellent
in
question.
a steady state?
Sure. In a steady state, we need about 350,000 apartments built in the United States just to maintain demand and supply, and that's without this significant increase on the demand side. If you kind of go back over time and average, you have to be careful of averages. If the standard deviation is wide, the average is less valid as a benchmark than if it's a very narrow standard deviation. But we need about 350,000 in a normal demand environment to stay steady state. We're already 95% occupied nationally. And there is about 167,000 apartment homes that get torn down each year. You know, most of the apartment homes in the United States are what we call garden style. They're much like these buildings that we're in here, except they're built with lumber instead of concrete, and they don't have a 40 or 50 year life. They might have a 25 or 30 or 35 year life, and then stuff gets built up around them, higher density, and there's about 167,000 apartments each year that are torn down. So if you factor that into the equation, it's even a higher number that we need to add in terms of new supply just to maintain a steady state. So we are right now at about 275,000 apartment starts this year, which will be delivered in 14. We need to be delivering 350 or more, 350,000 or more to keep occupancy where it is, which is why occupancy is projected to go higher. Yes?
I'd like to ask you, I don't know if this has an impact or not, but I read a while ago that in January 1st, 2013, that there's going to be a pouring of foreclosures on the market, that the government is somehow...
Yes, on single-family home foreclosure.
Yeah, can you refer to that? Because I don't know, is it true? How much is that going to affect this?
It's not going to all happen January 13th or January 1 of 2013, but yes, the government, well, single-family mortgages loans in the United States were primarily guaranteed by the government. You know, the loans were pooled and sold to investors, much like yourselves, and there was an implicit guarantee by the U.S. government. These are Fannie Mae mortgage pools, and so Fannie Mae has had to foreclose on a lot of homes because they made loans to people, and I could talk for hours about that, who never should have gotten a loan. You know, no down payment, no verification of income. The stories are terrible. So there was a lot of foreclosures that occurred over the last number of years. Those foreclosures are not, it's a very good point, they are coming to the market to be sold, but those foreclosures, for the most part, are already occupied. They're not occupied by people who bought them because they've been foreclosed on. They're owned by lenders, but they're occupied already by people who are renting those homes. So we've had essentially no new construction of single-family homes in the last 3 or 4 years in the United States. Essentially zero new supply, just like almost zero new supply of apartments. And there was a significant excess inventory going into 2007, and since there's been no new construction essentially since 2007 in the single-family market, that supply, that excess inventory, has been absorbed either by those people who were buying homes, and remember, we still have this generation here that is now in their home buying years, and so they're buying homes. And this generation, this generation already owns homes, so this is incremental new demand. And so you need to have some incremental new homes. It was just too much was built at one time for the demand. That supply of homes in most of the markets in the United States has already been absorbed, either by people who bought them or by people who are renting them. So there is not an overhang of supply of rental homes in the U.S. that are vacant. That's been absorbed over the last several years. It's a very good question. And we track that because you can almost track, there's a very high correlation between the availability of single-family homes for rent and the occupancy rate for apartments over the last several years. And as that single-family home availability for rent has declined because of absorption, either they were sold or they were rented, apartment occupancies started to grow. You know, we had, during this time period here, November 8 to September 11, in the United States, there were not a whole lot of new jobs created. But yet, the occupancy of apartments, or the vacancy for apartments, went from 8.6% to 5%. Why? Part of it was because the single-family market, those assets or those homes were absorbed by people who either bought them because they did have jobs, and still a whole lot of people have jobs, 90% or more have jobs in the United States, or they were renting. So we're not concerned in the markets that we operate in about any overhang of rental homes because that's been absorbed over the last 4 to 5 years. But it's a very good question. We look at that, we think of that as shadow inventory. It's very hard to track, but there is data that's available.
So you don't think that that there's going to be a glut because they're already rented?
No. No. What's going to happen is they're going to move from Fannie Mae's balance sheet, and they're going to move to someone else's balance sheet. And Fannie Mae's going to take a big loss. The U.S. government's going to take a big loss. And someone's going to buy those at a very attractive price. And there are a lot of capital that's looking, there's billions of capital that's looking to buy those assets when the government essentially unloads them. We know that as a company, we know that marketplace very well. Stephen DeFrancis, who formed Cortland back in the mid-90s, used to own and manage 1,000 single-family homes. We've decided not to play in that space. We think this space is a much better return profile. So you may have an opportunity to invest in that single-family market pool, and we as a company have just chosen not to do it, and we have a fair amount of knowledge about what it takes to operate those things. But there's a lot of capital chasing it. But we're not concerned at all about the inventory, because the inventory's already been there and has been absorbed. It's just going to change from one person's balance sheet to someone else's balance sheet.
We shouldn't buy stock in Fannie Mae, is what you're saying. I'm joking.
Yeah. Well, they've already taken them right down, so maybe theirs is actually okay. So we've got this set of dynamics that are occurring in the space market. But in the U.S., and I'm not sure how it is here, but probably likely very similar, capital markets impact real estate valuations significantly. And so as we look at how capital markets are going to recover, this probably happens here, and you can invest globally as well. When capital comes back to a sector, the bond market, technology, healthcare, manufacturing, it doesn't matter which sector. Once it's been away and it comes back, it always comes back first to the blue chip companies. Because when it's been away, all values are down. And so when it comes back, it first goes for the highest quality companies, the blue chip companies, because their valuations are down. And it buys them and it bids those prices up. And then when they get fully valued, it starts to look downstream to the next tier of company for valuation and yield. You know, you go from AAA bonds down to AA, down into the mid-Bs. Likewise for companies in any sector. Well, the same thing happens in real estate. And this is a chart which tracks cap rates or going in yields when you buy apartment properties in the U.S. And what you see here is a stratification, and this is apartments, not office buildings and not retail centers, but apartments. And what you see here is there's this normal spread between the A properties, blue chips if you will, and the next tier, the Bs and the Cs. And this kind of normal spread will vacillate a little bit over time, but there's this normal spread that's compensating for a different type of return profile, and maybe a different type of risk profile. Well, as capital started to come back in late '09 into the apartment space, the capital first went to the Class A assets, the highest quality assets, and in only 5 cities, really. The gateway cities in the U.S. Washington, D.C., New York, Boston, San Francisco, and Los Angeles. Well, boy, Houston is a great place too, for a variety of reasons, but Capital went to Houston as well. But Houston is not considered a gateway city, quite frankly, from a real estate perspective. But it's a great city, and we own assets in Houston, and like 45% of Houston's economy is driven by the energy industry. My guess is most of us in this room would think that the energy industry has good fundamentals for a number of years to come, and so you can imagine Houston does very well when that happens. But there's this normal spread between the A's and the B's and the C's. But when the capital first came back, it came back to the A properties in the gateway cities, and it started to drive up the prices, drive down the yields. And you've seen this yield collapse here. This is tracking cap rates across the U.S. This was in late '09 when it first started to come back into the space. And it spread to those gateway cities, and then it started to spread to the blue chip assets in markets across the country. Denver, Dallas, San Diego, Seattle, Miami, you name it, it went to those blue chip assets first. Well, and what happens is as it declined, the normal spread between the A's and the B's gapped out. And you see this in any other sector as time goes on as well. And so today, from a capital market perspective, there's an outsized yield opportunity to buy at the B level. Because that normal spread will return, reversion to the mean. It will return as capital looks at these assets and says they're fully priced, and I'm going to go downstream for valuation and yield. And as the capital moves downstream, it'll start to bid the prices up of these assets, and the yields will drop back to this normal range. And this will happen over time. Probably in 2014 and 15, we'll see a meaningful shift of capital looking for the next tier of assets for valuation and yield. What happens in the apartment space when things get soft, so 2008, 2009, when things get soft and occupancies decline, the better quality assets, the A quality assets, will fill their occupancy back up by dropping their price. Supply and demand. They need occupancy, they just drop their price. And those who are living in a B apartment property can now move into an A apartment property. It's a nicer one because they can now afford it. And so the A's get full, and then the B's lose some occupancy, and the B's drop their rents, and they pull from the C class property. The C people move into the B fills up, they're okay. The C has now lost occupancy, there's nowhere for them to go. The next level down is government assisted living, and so there's nowhere for the C's to go get occupancy to build it back, and as a result they get hurt the worst. They're the ones that go into foreclosure first as a result. Now, when markets start to recover, which is where we are now, the A's are already full, and they start to push their rents, and as they push their rents, the marginal renter gets pushed down to the B. The B is full, the B's start to push their rents, the marginal renter gets pushed down to the C. The C's fill back up. And so that cycle happens time and time again when you go through, I hate to say normal recessions, but normal recessions relative to significant recessions as we had over the last several years. So there is, as the B's, and they're starting to fill and start to move their rents, the capital that's chasing A assets that are fully valued will start to then move downstream to the B assets. And this could be individual assets. You could also apply this to markets. DC, New York, Boston, Dallas, and then you can go here to the next tier of markets, Orlando, Austin. You could look at these as individual markets. You could look at them as individual properties or classes of property from a quality perspective. But these cycles happen time and time again, and they repeat themselves. Yes.
So the best investment is in Class C, according to this graph.
It is. Although this is going to be the last group to recover. The B's will recover first.
Over the years, the yield for Class C is the highest anyhow.
It is the highest, And this is showing yield. It's the highest, but it's also the most risky of these classes of assets. When you go through a downturn, it's the one that gets hurt the worst, fastest. And so it's a risk-reward play, as any investment is. The ability for the renter profile at the Class C to absorb rental increases is less. They have more of an affordability issue. And so you can get more growth here, but people, guess what? People are paying for that growth by pushing these yields down.
You know, from today, it's almost double.
Yes, that's right. So it's all given your risk profile. We at Cortland bought C assets in 2010 and the first part of 2011, back up here. As you'll see, a little capital has come into this space and pushed the yields down. More capital has come in here. Significant amount of capital has come in here. It's just a normal capital cycle that we go through. So today, we're primarily looking at the B space to capture this differential on the spread for yield, because this will compress. Cap rates for Bs will drop. We already own them. We're all going to get, this is the total market. We're all going to get increases in occupancy and the result increases in rents. The question is how quickly they will be able to be realized. And you'll realize more of the rent growth here, faster than here next, and this is last to recover. But depending on where you enter, you're absolutely right. There's a time to play at the C, there's a time to play at the A.
Is it more expensive, Class C or B? If you compare them,
Oh,
be more expensive.
most expensive, next most expensive, least most expensive.
Least expensive.
Yes.
Is it the least expensive or the most expensive?
Very good question. It is the least expensive on a per unit basis, shekels, if you were to invest. It's the least expensive on a per shekel basis, but it may be the most expensive on a risk basis. It depends on which way you're looking at it. And you cannot look at return. You should not look at return without looking at risk. You should not look at demand without looking at supply. Those things all go together. And so this is what's happening in the U.S. You've got...
How much is the difference between B and A, for instance?
Well, properties here, and I'm not going to use Manhattan, because Manhattan is a different place than the rest of the United States. But you might buy a property here for $150,000 per apartment. You might buy these at $25,000 per apartment.
I mean the B and the B.
In the B is going to probably be, and it's different market to market. I'm just trying to use an average. The B is going to be in the 50 to 70 range. 50 to 70 range, yes. So, and it's different. A B property in San Francisco is going to trade at a much higher price than a B property in Charlotte, North Carolina. They're just, so it's you have to go market by market. But the general spread between them pretty much tracks individual markets. There's no doubt. So in the U.S., we've got two things occurring in the apartment space. Different from office, different from retail, but we've got this capital flow equation, and we have the supply and demand imbalance in the space market. So I would tell you that the conclusions, from a general perspective, is that demand is significantly increasing for apartments because of the demographic wave and because those who would normally move out to buy a home are staying in apartments longer. How much longer? To be seen, but they're staying in apartments longer because of other market forces. On the supply side of the equation, the banks still haven't financed enough new supply to meet demand. So supply is significantly behind demand and will likely be for 3 or 4 years. Now, I will tell you what was going to happen, highly likely going to happen. We're going to have a significant increase in rental rates and occupancy rates in apartments over the next 3 to 4 years because we cannot deliver enough supply to meet demand. The banks will free up. The banks will finance a significant amount of new construction in 14 and 15 and 16, which will get delivered in 17 and 18 and 19. And we will probably, in those years, deliver more supply than we have demand. Let's look back at this chart. As we get out to the latter part of this decade, the shift in this increase starts to flatten out. There's still a lot of people, but the rate of growth in the number of people starts to flatten out. It's going to align with the time period we've done it time and time again in the U.S., where we are going to probably deliver more supply in the latter 2 or 3 years of this decade than there is incremental demand at that point in time. And this is going to back up a little bit. But that's okay. And there'll still be great returns. But we will deliver more supply at some point in time than there is incremental demand. Over a 10-year time period, we'll probably deliver enough new supply to meet new demand. The market is efficient over time. Has been always. But at any point in time, it's inefficient. For the next 3 to 4 years, we can't deliver enough new supply to meet demand. My guess is at 17, 18, 19, we won't be able to generate enough new demand to meet the supply that's going to be coming. So our perspective as an investor, and we are an investor in real estate, is that if we're investing today, we would like to be out of the asset by the time the end of 2016, or make sure that our capital structure, primarily the debt, doesn't come due until 2020 or beyond, so that we don't have any debt maturities in 17, 18, and 19, when values are likely to back up a little bit. We don't want to have any pressure there on any refinancings. So we're looking to either monetize investments by the end of 16, and we won't monetize everything, we won't sell everything. But those assets that we will hold during a time period where there's likely to be some excess supply, we don't want to have any debt maturities during that time period. We want to bridge that likely downturn. We will have enough demand over time to absorb the new supply. It's just not going to be delivered all in sync with one another. We're going to have excess demand for the next 3 to 4 years, then a couple of years where it's probably right on line, and then probably 2 or 3 years where there's excess supply. We've done it time and time again. We will do it this way. And it's really a function of influence in the capital markets, when financing is available and when it's not. We should be delivering more supply in the U.S. today because we have increasing demand for apartments. We're not, because the banks didn't loan us the money 2 or 3 years ago. 17, 18, and 19, they will have started up and made a bunch of loans, and we'll deliver more supply. And so, as we think about the business and how we position ourselves, and by the way, going into those years, late in this decade, I don't want to be owning Class C assets. Because what's going to happen? Things are going to get soft, occupancies are going to back up, the A owners are going to want to protect their occupancy, so they'll drop their rents and maintain their occupancy by pulling people up from the Bs, as I mentioned. The Bs will then lose some occupancy. They'll want to protect their occupancy. They'll buy it back by dropping their rents, attracting people in the Cs up to the Bs. The Cs will then lose some occupancy. They can't drop their rents. There's nowhere there's not another group of people to move in. So that's the risk profile relative to the Cs when things go the other way. So Cs are a great buy today. I would tell you should have a shorter hold period on a C than you should have on a B or an A because of those dynamics. There's also some differences in the cost of maintaining those assets. It's not uncommon, matter of fact, it's normal for the C assets to have to be older in life, the asset, and therefore it costs more to maintain them. Capital expenditures, roofs, infrastructure, appliances, and so forth. But that's usually underwritten into the yield process. But that's where some people can make a mistake. And so, as we're positioning our investments today, we're primarily buying here. We are buying some of these in individual markets, and the markets are all different. What's going on in Atlanta today is different than what's going on in Houston. Houston is getting 8.5% rent growth. Atlanta's getting 4% rent growth. Jacksonville had 0 rent growth last year. So their markets play differently given their underlying economies. And you can look at how markets perform. If I'll get to a slide here, and this is not blown up very much, but there's a cycle. There's a time to acquire, to generate outsized return. There's a time to develop, and there's a time to sell. And that's pretty academic. But the markets that we're focused on, and this doesn't mean other markets in the country are not good. These are just the markets that we have made a decision to invest in based on research. And we look at correlations. For example, what's the underlying economy in Houston? What type of jobs support the Houston economy relative to the national economy? I mentioned earlier 45% of the Houston economy is energy. Well, 45% of the U.S. economy is not energy. And so Houston has a very low correlation, 0.61, correlated with the national economy. It has a beta factor, though, of 1.2, meaning for every job created nationally, there's 1.2 jobs created in Houston. For every job lost nationally, there's 1.2 jobs lost in Houston. You look at other markets, Atlanta, where we're headquartered. Atlanta has a very high correlation with the U.S. economy, 0.81. So the job stratification in the Atlanta economy is much more aligned with the job stratification nationally in the U.S. Atlanta has a beta factor of 1.4. For every job lost, there's 1.4 jobs lost in Atlanta. For every job gained nationally, 1.4 jobs gained in Atlanta. So Atlanta is really the U.S. economy on steroids, up or down. And so depending on where the U.S. economy goes, Atlanta will outperform or underperform. And so these markets all have correlations. It's based on the underlying jobs that support these economies relative to the national economy in the United States. And then you look at how markets are correlated with one another. We don't want all of our markets going up at the same time because they will all go down at the same time. Because they're supported by, they'll be supported by the same types of companies, and they would hire and reduce their workforce in tandem. And so it's important to have markets that are diversified. And so that's, I'm getting into more of a Cortland story than a national factor. But there are plenty of other markets around the U.S. that are great markets to invest in. These are just the markets that we've selected, given our research and our experience. We don't have experience within our firm in Seattle or in Chicago. That doesn't mean those marketplaces are not good places to invest. It's that given the breadth and depth of experience within our firm, we're comfortable with this part of the U.S. economy, or geography, if you will, and then selected markets based on that. So it's important to look at what's going on in the space market and what's going on in the capital market as you make real estate decisions, both to invest, and I would suggest that this is extremely important, the sell discipline. If you made a good investment and values have run up, you've created value in a firm like ours that creates value, not just rides the market. You want to monetize that value, and you monetize that value by selling. Probably the biggest mistake most investors in the U.S. have made is believing that this line of the cycle will continue to go up, and they hold it until this happens, and then they look back and go, I wish I had sold. Now, this can be a long time period, it can be a short time period, there's a lot of factors that go in there, but the sell discipline is extremely important.
Where is the U.S. Real estate market in this cycle?
Well, I could speak to the apartment side of the equation. Maybe a little bit to the office side. The office side is about right here. Not Manhattan, but the U.S. economy, the office is about right here.
Manhattan is like Tel Aviv.
Yes. Tel Aviv is a great market. Yeah. The U.S. economy on the apartments, we think we're about right here on the apartment side. We are starting some development, our firm. Others have already started development, and it's justified. You saw the demand projections. New supply is justified. But we can still generate development-like returns by buying assets today, capitalizing on that yield spread differential, which will compress. And we'll enter a time period over the next 2 to 3 years where capital has moved downstream from the blue chip assets into the B space, push the B asset prices up. And at that point, we won't be able to generate those types of returns on B assets anymore because the capital will be there buying that yield evaluation. And so we'll then start to redeploy more of our capital into the development side of the equation. And we'll be playing different markets because the different markets cycle out of phase with one another. But the sell discipline is extremely important. And as I mentioned, we want to not liquidate all the portfolio. We want to monetize a lot of our portfolio, or a significant portion of our portfolio, by the end of 2016, or be positioned to hold it until 2020 and beyond. So, questions? Any more questions that I can help with? Yes.
Yeah, okay. I see from your map here, from your blue circles, that you're only in the East Coast and the Southeast Coast.
Yes.
You're not in, and that's it. That's where you drew the line. You don't really like to. I just want to know if you can give your opinion about Phoenix.
I can.
Good.
It's an opinion. So, Phoenix is a market that has similar job stratification, underlying economy, to what you would find in Atlanta or Dallas. And so it's a market that has good job potential. It's a market that on the supply side of the equation, we get a little bit concerned about because Phoenix is surrounded by desert, and all you really have to do is get a water hose and pour the water out there, and you can create a new piece of land that you would live on, right? So there's not much of a geographic supply barrier there. And so you just have to be careful about your timing. Phoenix has recovered well. I don't know exactly where it would be on its cycle, but Phoenix is a place where there will be a lot of jobs created and there'll be demand. And I'm a believer that you look at demand first and then figure out supply, because you don't go anywhere without having demand, in my opinion. So I think Phoenix is okay. Yes?
This graph shows actually continuously growing from the acquire stage up to the sell stage.
Yes.
Usually in such a model, it should be some retracements that can be entry
Sure.
point for some people, and here there is no such opportunity.
I understand this is an academic chart. Individual markets will go differently, but just generally, if you had to just make a broad statement about the cycle, a cycle cycles, and these are the various stages that are within that. So, but an individual market doesn't follow this exact cycle line. It's more of an academic exercise here, but the general phases are there. But there's a time to acquire, and you could sell right here. We acquired assets here that we sold here. You don't just sell here. You can sell all along the curve.
So there are some
Oh, yeah. Oh,
opportunities for
no
other
doubt.
people to join.
Sure,
It's not-
exactly. What you don't want to necessarily do, though, is invest all the way through the curve, because then you're investing here when this occurs. But you can sell all along the curve if you've generated the type of return profile that you're looking for, or if you think that you've optimized your risk return on that investment. I would suggest that you could sell anywhere along the curve. Selling, though, is important. Somewhere along the curve, it's important.
You can also get a loan from the bank. You don't have to invest all this.
That's right. Yeah, our financing. Yeah, financing for apartments is very. Fannie Mae and Freddie Mac, which were problems for the single-family home market, they also make loans for apartments, residential, and very, very attractive rates. We're borrowing, and we're not the only ones. People in the U.S. are borrowing from Fannie Mae and Freddie Mac in the 3.5% range for 7 to 10 year financing. It's extremely attractive capital. As a matter of fact, if you hear some people talking about real estate values are now back at peak values in 2000 that they were in 2007, they are in many cases. But debt cost in 2007 were 6%. Debt costs today are 3.5%. So return profiles are not back at peak valuations. Because both of those components, space market and capital market, thank you for your time today. If you'd like to follow up on investments in the U.S. with Cortland, does a lot of work with us here in Israel And so I would point you to him as a contact person, and he can get in touch with us as we move forward. Thank you.
Thank you.